Group Statements, Chapter 7, Examples 7.6 and 7.7. Example 7.6 and 7.7 looks at the scenario where the required value adjustment at acquisition date relates to the investment property of the subsidiary. In example 7.6, the scenario deals with a required fair value adjustment on the investment property of the subsidiary that has been accounted for by the subsidiary at acquisition date before we consolidate. There will not be any business combination valuation journals necessary in this example, and it is therefore self-study. Example 7.7 looks at the scenario where there's a required value adjustment on the investment property of the subsidiary at acquisition date, but in this example, that value adjustment is not accounted for by the subsidiary in its separate financial statements at date of acquisition. The acquisition date is 1 January 20X9, and on this date, the investment property is measured in the trial balance of S at 100,000 Rand. On 1 January 20X9 being my acquisition date, the identifiable assets and liabilities of S were considered to be fairly valued except for this investment property that was undervalued with 20,000 Rand. So this 100,000 Rand on the trial balance is undervalued with 20,000 Rand. It is the accounting policy of S Limited to account for investment property in terms of the fair value model in IAS 40. Why then did the subsidiary not account for this value adjustment? We make the following assumption. Assume that this 20,000 Rand increase in fair value resulted from a non-adjusting event in terms of IAS 10 that took place after 31 December 20X8, and therefore the financial statements of S Limited for the year ended 31 December 20X8, which would be my starting point, the trial balance above, were not adjusted for this increase. Consequently, this value adjustment on investment property would have to be done through consolidation journal entries. You would have to increase the value of the investment property by 20,000 Rand and create a corresponding credit to the equity of the subsidiary at acquisition date. Remember, fair value adjustments on investment property is recognized through profit and loss. So the equity item that you have to create in a scenario like this would be retained earnings. The fair value of this investment property increased with a further 30,000 Rand to a carrying amount of 150,000 Rand on 31 December 20X9. S Limited recognized a total fair value adjustment on this investment property for 20X9 amounting to 50,000 Rand. The reason why S recognized the 50,000 Rand value adjustment is because S did not value adjust for the 20,000 Rand at acquisition date. When we consolidate, we usually consolidate at the end of a reporting period. So we will now investigate this consolidation process for the year ended 31 December 20X9. So the consolidation process at 31 December 20X9 would be as follows. On this date, we have the following trial balances of the company, reflecting the investment property in the trial balance of the subsidiary at the 150,000 Rand. It is important to understand which reporting period we are currently busy with. At the end of 20X9, S processed a fair value adjustment of 50,000 Rand on this investment property, resulting in the carrying amount of 150,000 Rand. The profit for the year of the subsidiary is listed in the trial balance as 110,000 Rand, and the fair value adjustment of 50,000 is listed as a separate line item. This trial balance now represents my starting point for the consolidation of this group for the year ended 31 December 20X9.